Federal Reserve System. The Federal Reserve System sets monetary policy, which is changing the rate of growth to affect the cost and availability of credit. This is what the Federal Reserve System is run by the Board of Governors. They're the ones who are responsible for this. They're the ones who are supposed to be watching interest rates. And it may seem simple, but all they're trying to do is just affect all this through changing interest rates. And there's very few little other direct action they take. But this one direct action is huge. It has a number of different possible effects, both good and bad. So you could say that whoever the president puts on this actually, and on this board of governors, actually has more ability to affect the economy than the president himself. The ability to change interest rates, which is the cost of credit, makes a huge difference on how the economy performs, because it affects people's personal loans, businesses' ability to expand through loans, financing, and all the things we've talked about. We've talked a lot about interest rates. These guys set those interest rates, the standard interest rates for credit. Now, other companies may charge more, but they set general interest rates. So functions of the Fed, things that the Fed actually does. Again, the Fed is short for Federal Reserve. They regulate the money supply. So those M1 and M2 we talked about, they're the one making sure that there's not too much money so that we have a problem of inflation. They're making sure that checks actually get cleared. So when you write a check or when you swipe your debit card, they're the ones that regulate to make sure that money actually is taking place and no one's getting scammed, electronically. They act as the government's fiscal agent. I mean, that's obvious. They're the one. Fiscal is kind of saying for the economy of the nation and the money supply. So they control that. We've kind of covered that. They supervise banks, make sure banks are following the rules. They're not scamming anybody outside of what the law might allow. That's a whole different subject. Holding reserves and setting reserve requirements. Reserve requirements are that minimum amount of money that a bank has to have on hand at all times to make sure that they can, give people money when they ask for their money back. And the rest of it, after minimum amount, they can use to invest. And that's how banks really make profit. And finally, actually supplying the paper currency. They engrave it. They decide what it's going to look like, its security features. All that stuff is done by the Fed. Money supply and the economy. Yes, more about the money supply. So we talked a little bit about what the Fed does. Now there's two different attitudes that they can have towards the money supply. One is a loose money supply. That means, because again, the Fed controls the cost of credit, so they can make credit cheaper. Now this will make borrowing more easier because it's cheaper. Consumers tend to buy more because they can get loans at cheaper rates, so it makes more sense for them to take out loans to buy things like various durable goods, cars, homes. More people tend to be employed because businesses are now less afraid to expand, because if they need to take a loan, it won't be so expensive. And just there's generally more spending. However, if credit becomes too cheap for too long, that can cause inflation, and that's a big risk. That means your money starts to actually lose its purchasing power and becomes less valuable. Now, the other side of the coin is a tight money policy. That means when the Fed employs a tight money policy, they're making credit more expensive. They're raising those interest rates. That makes borrowing more difficult. Consumers will tend to buy less. Businesses are going to expand later on rather than right now because, again, they need financing to do a lot of those bigger expansions. Unemployment can increase. And overall production can be reduced. If it goes on for too long, it can lead to a recession because businesses will start to fail. Now you might think well, why ever do tight money policy? Well, because inflation. Inflation can also cause all those things in the orange downward arrow. So you have to balance between the two. You can't just keep it loose cheap credit all the time. You have to increase credit. The Fed has to increase credit cost gradually over time. But it's a balancing act. Too high, we can get a recession. Too low, we can have inflation, which also can lead to some pretty bad economic situations. So that's the balancing between the two. You very rarely will have a Fed that'll just do all one or the other. It's balancing between the two. Fractional reserve banking. I mentioned this a little bit in my last video. There's two components of fractional reserve banking. This is the safety net because once upon a time, banks weren't required to keep cash on hand. So when you put money in a bank, that bank then uses a lot of that money to invest and make money. That's right, they're using your money to make money for themselves. Now the problem is that, again, once upon a time, going back earlier 20th century, they didn't have to keep anything in reserve if they didn't want to. Good banks always would, but many banks that weren't so good and were more risky with the investments of the money people were giving them. When people wanted to get that money, they may not have it, and then they've been essentially robbed, those people. And then that bank might close down, and they might lose even more money, which means even more people can't get money back, and you can have a major collapse, which is what happened in our past, in the Great Depression. So there's a reserve requirement, a minimum amount of money that all banks have to have on hand at all times, so that they'll never be able to say to a customer trying to get some access to their checking account, their saving account, oh, sorry, we spent it all. No, they have to have enough to make sure that, maintain day-to-day business. And then the rest, that's non-required reserves, they can invest that. They can loan it out to people. So when you get a loan from a bank, technically that's money they got from someone else that they're now loaning to you to make profit through the interest. And this is the reason why currency, true currency, cash and bills and coins, is only a small portion of the money supply. Because let's say you deposit $1,000 into the bank. If the current reserve requirement is 10%, that means the bank has to take 100 of that and leave it there. They can't touch it. But the other 900, they can do what they want. So they can take that 900 and then spend it on something, or invest it, or maybe loan it to someone else. Well, what if someone else puts that $900 into the bank? Well, reserve means the bank has to keep that 90, but that 810 can go back out. Now that bank is now put into people's hands a total of $2,710 because they're putting money into the system and only keeping some of it behind. That money then can go out and be spent in the economy and then be put back into a bank again, because again, that's where everyone keeps their money, and it can keep cycling and through, and that's how money supply can grow, just through day-to-day bank operations of people putting their money in the bank, and then that bank using that money to invest and spend and make loans. And they can increase how much money's out there, even though actual bills and coins are not being produced. So, changing reserve requirements. Sometimes the federal government will change the reserve requirements. In the last video, we had the example of 10%. They can change it higher or lower to affect the money supply. If they make it higher, it'll reduce the money supply because the banks will have to hold back more. If they reduce the reserve requirements, then the banks don't have to hold back so much and they can spend more. So what happens if a bank gets in trouble, though? They dip below their reserve requirement. Well, they're not automatically going to be punished for that, but they're going to have to take a loan from the government. And the government will make money on the paying back of that loan, the interest rates. And the rates that they charge are known as the discount rates. So they might be more favorable rates. They don't want to crush businesses or banks that dip below the reserve requirement. But there has to be some kind of consequence. So one of those is the cost of credit. They're going to have to take a loan and pay this discount rate. And then now banks then will use that rate to help to decide what their prime rate is, and that's the lowest rate that they offer to their best customers.